Everyone online says SCHD is the safest way to get rich slowly. But let me ask you this. What if the safest strategy is actually the riskiest thing you could do right now? Let's set the stage. SCHD, the Schwab U.S. Dividend Equity ETF, trades around $28.50 per share right now, with a dividend yield near 3.5%. It's built on the Dow Jones U.S. Dividend 100 Index, meaning it owns 100 big American companies that actually pay and grow dividends consistently. We're talking about giants like Broadcom, AbbVie, Chevron, and Home Depot. This isn't a get-rich-quick play. It's the slow, methodical wealth strategy. But in 2025's crazy economy, with 4.5% interest rates, sticky inflation, and constant volatility, does this slow and steady approach still win the race? Okay, so the video I watched claimed, just buy 5,000 shares of SCHD and you'll make $5,000 a year forever. At first, I thought, sign me up. But then, wait, 5,000 shares? That's about $142,000 at today's price. Not exactly pocket change. Still, the math sounds good. You buy your 5,000 shares, you collect around $437 a month in dividends, and if the dividend keeps growing, maybe you're pulling in over $10,000 a year in the next decade. But here's where my jaw dropped. Some people are projecting 12% dividend growth every year. And I was like, wait, are we in fantasy land? Because the actual historical growth is more like 8 to 10%, according to Dividend.com and Schwab's reports. So yeah, I had to pause the video right there. Minute 2:43. Hold up. 12% growth? Really? Let's give SCHD credit. It's not hype. Its expense ratio is just 0.06%. Basically free compared to those flashy active funds that eat your returns in fees. And the companies inside? They're no joke. They've survived recessions, pandemics, and now, a tightening Fed cycle. SCHD focuses on financials, healthcare, and consumer staples, sectors people don't stop spending on, even in crises. You see what that means? It's built for resilience. Not sexy, but solid. And boring is beautiful when markets crash. Steady, reliable, boring. But here's the drama. SCHD isn't magic. Its beta is 0.9, meaning when the S&P drops, SCHD follows. Maybe just a bit less. It's not some invincible tank. And yeah, you'll still pay taxes on those dividends unless it's in a Roth IRA. Uncle Sam always gets his cut. And here's something people forget. Dividend growth can stall. In high-rate environments, companies use their cash to pay debt instead of raising dividends. So, that dream of forever increasing checks? It can pause, even reverse. Imagine counting on that income, and it drops 10%. Not fun. So where does that leave us? If you're buying SCHD for income, it's fantastic. But if you expect it to beat growth stocks like tech ETFs long-term, you might be disappointed. SCHD's annual return since launch in 2011 is around 11%, but that includes years like 2021 when the market exploded. In slower times, like 2022 or now in 2025, it's closer to 6 to 8%. Still, when the Nasdaq's down 30% and your SCHD only drops 9%, you'll feel like a genius. This is why it's called the Sleep Well at Night ETF. You won't double your money overnight, but you also won't lose your mind every time the Fed tweets. Alright, let's simulate that 5,000 share strategy. If you invest $2,000 every month for 5 years, reinvesting all dividends, you could reach that goal, assuming prices stay around $28 to $30. By the end, you'd own about 5,000 shares worth roughly $145,000 and collect around $5,250 a year in dividends. Now add dividend growth, say 8% per year, and by 2030, you're making $7,700 annually. That's the power of compounding. Quiet, slow, unstoppable. let's not forget history, because it matters. In 2020, when the world shut down, SCHD dropped about 33%, but bounced back in less than a year. In 2022, when tech collapsed, SCHD fell just 9%. And here's the kicker. It never cut its dividend. That's the kind of quiet strength that builds trust. And trust builds wealth. So, can 5,000 shares of SCHD make you rich? Not overnight, not even in 5 years. But it can make you stable, financially, emotionally, and psychologically. You won't panic every market crash. You'll smile every dividend payday. And that, in a world full of FOMO and meme stocks, is real wealth. I'm giving SCHD a 9 out of 10. Not because it's perfect, but because it's honest. It does what it says, pays you to be patient. Still, never bet everything on one ETF. Diversify. Mix in growth, bonds, maybe some international plays. SCHD is the backbone, not the whole body. But what do you think? Would you actually save up to buy 5,000 shares? Or do you think this dividend dream is overrated in 2025's economy? Drop your thoughts in the comments. I want to know how you see SCHD fitting in your plan. And hey, if you found value in this breakdown, hit that like button, subscribe, and share this with someone who keeps talking about passive income but hasn't done the math yet.